Hello students, I welcome you all to this video lecture on input tax credit. In this video, we'll try to learn in brief about the topic. In simple terms, input tax credit is the mechanism where the SSC can reduce the output tax payable by deducting the tax which has already been paid on the inputs. Let us understand this with a small example. Let's say the SSC is into the business of producing and selling sweets. In this particular case, let's say he is producing and selling Kaju Barfi. He would require cashew nuts, milk powder and sugar to manufacture or produce the sweet. So let's say he purchases cashew from supplier A, he purchases milk powder from supplier B and he purchases sugar from supplier C. The output or the product that he is selling is Kaju Barfi. If you notice, he has to pay output tax liability of 450. That is, when he has sold his product, that is the sweet, to the customer or to the next person in the supply chain, there arises an output tax liability of rupees 450 which he will be liable to pay to the government. If input tax credit was not there, he would have to pay this full 450 rupees to the government. But thanks to the concept of input tax credit, the output tax that he has to pay will reduce significantly in proportion to the input tax credit that is available. So he purchased cashew nuts from supplier A. Supplier A has paid 100 rupees as tax on those cashew nuts. So this 100 can be claimed as input tax credit by the SSC. He has also purchased milk powder from supplier B. Supplier B has paid 120 rupees as tax on that commodity. This 120 will also be claimed as input tax credit or can also be claimed as input tax credit by the SSC. Finally, he has also purchased sugar from supplier C. The supplier has paid 80 rupees as tax on those sales. So, as this sugar is also an input for the SSC, he can claim rupees 80 also as input tax credit. So, in total 100, 120 and 80 is 300 rupees. So, the SSC has input credit of 300. He has to pay 450 to the government and he has 300 rupees as tax credit. That means instead of paying 450, he can set off rupees 300 as input tax credit from this amount of 450 and he has to pay only rupees 150 to the government. I repeat once again, 450 is the output tax liability and rupees 300, that is 100, 120 and 80, that becomes 300 is the input tax credit available. So once you set off this 300 from rupees 450, what remains is rupees 150. Hence, the tax that the manufacturer needs to pay to the government is only rupees 150. The biggest advantage of the concept of input tax credit is it does away with the cascading effect of tax. Earlier, what used to happen is on commodity A, the supplier used to pay tax, the SSC also used to pay tax. Once again on commodity B, the supplier used to pay tax, the SSE once again used to pay tax. Same would happen with commodity C. What was the impact is that the tax on the same product would be paid 2, 3, 4 times in certain cases. So now, thanks to input tax credit, any commodity for that matter, the tax would be paid only once. The tax incident on that particular commodity which is covered under GST would be paid only once. So, what are the types of GST that are there? In brief, there are about 4 types of GST, that is intra-state movement or intra-union territory movement. In that case, CGST, SGST, and there is something called as UTGST. Interstate movement is movement from one state to another, that is movement of goods from state A to state B, that is outside the state. In that case, we will have to pay integrated GST or IGST. Now let us understand how to claim input tax credit. Most important points are noted here. The SSE must have a tax invoice or debit note issued by the registered dealer. Very important. If the tax invoice does not match, the SSE will not be able to claim any input tax credit. The SSE should have received the goods or services, that is, advance claim of input tax credit cannot be done. Only after he has received the goods and services, he can claim input tax credit. The tax charged on your purchases has been deposited, paid to the government by the supplier in cash or via claiming input credit. That is, the person from whom you have purchased the products, that is, inputs that you have purchased, that particular supplier should have already paid the tax. If that person has not paid tax, you will not be able to claim any input tax credit. And most importantly, the supplier should have filed GST returns. Only if everything is in affirmative to the points discussed here can the SSE claim input tax credit. So, how does one set off the input tax credit as against output tax liability? As discussed already, there are 4 types of GST: IGST, integrated goods and services tax; CGST, central goods and services tax; SGST, state goods and services tax; and UTGST, union territory goods and services tax. If input tax credit is available in IGST, in such a case, first, such input tax credit should be set off against output tax liability of IGST itself. The remaining amount can be set off against CGST, SGST or UTGST in any order. There is nothing against which IGST cannot be set off. That in short says that IGST or input tax credit available under IGST can be set off against any type of GST. If ITC is available under CGST, first such amount or such tax credit should be set off against IGST. Next, it should be set off against CGST. Please remember, any input tax credit available under CGST cannot be claimed as deduction or cannot be set off against SGST or UTGST. This is most important for you to remember. The tax credit available under CGST cannot be set off against SGST or UTGST. What happens when the input tax credit is available under SGST? Once again, it can be first claimed as against IGST, as against the output tax liability of IGST. Next, it can be set off against output tax liability of SGST. But once again, please remember, it cannot be set off against CGST. Union Territory GST, whatever input tax credit is available, can be first set off against output tax liability of IGST. The remaining amount can be claimed or set off against Union Territory goods and services tax. Once again, it cannot be set off. Please remember this. It cannot be set off. The input tax credit available under UTGST cannot be set off against CGST. Impact of Rule 88A and related provisions. IGST credit is to be utilized first against IGST liability, then against CGST, SGST, UTGST liability in any order. Taxpayer has to exhaust input tax credit of IGST first, followed by CGST, SGST, UTGST credit. IGST liability will be set off first compulsorily. What this essentially means is, until and unless you are done away with input tax credit available under IGST, you cannot claim any other credit available under any other type of GST. Primarily, whatever input tax credit is available under IGST, it should be first set off as against IGST or CGST or SGST and UTGST. Does not matter, but all the tax credits, input tax credits available under IGST should be set off first. Then you can claim or you can set off the tax credits available under CGST, SGST and UTGST. There are instances where amount of input tax credit available in the electronic credit ledger will be greater than the amount of output tax liability. Let us say your output tax liability is 500 rupees, but tax credit available in electronic credit ledger is 600 rupees. What do you do then? When the input tax credit available in electronic credit ledger is more than output tax liability, in such a scenario, the SSE can carry forward the unclaimed balance of ITC to the following months. That is, as I gave you the example, your output tax liability is rupees 500. There is rupees 600 input tax credit available in electronic credit ledger. So once you set off output tax liability of 500 rupees, you'll have a balance of 100 rupees in electronic credit ledger. This rupees 100 can be carried forward if the amount available in electronic credit ledger is less than the amount of output tax liability. Then the SSE has to pay balance amount to the government. Let's change the amount. Let's say output tax liability is rupees 600 and you have rupees 500 in electronic credit ledger. In such a case, you will have to first set off those 500 rupees worth of input tax credit as against rupees 600, and it is common knowledge that rupees 100 will be the remaining tax payable, or output tax liability will be rupees 100. This balance amount you will have to pay to the government. Input tax credit cannot be taken on purchase invoices which are more than 1 year old. Period is calculated from date of tax invoice. This essentially means that whatever input tax credit you have to claim such tax credits within 12 months from the date of tax invoice. Since GST is charged both on goods and services, input credit can be availed on goods and services except which are on exempted or negative list. If the government has not specifically stated that particular items or goods and services are exempted from taxation, all the remaining goods or all the remaining goods and services you can claim input tax credit. As we all know, input tax credit is available on capital goods also. Input tax credit is not allowed for goods and services for personal use. This is very important to remember. Those goods and services which are purchased for personal use, on such goods and services you will not be able to claim any input tax credit.